This walkthrough is for illustrative purposes only and is being conducted with a test account. To get started investing, you need a UK address, UK bank account, and a UK national insurance number. You can find your national insurance number on documents like payslips or letters about tax, pensions, or benefits, or by logging into your personal tax account on gov.uk or using the HMRC app. Let's get started. First, you need to sign up. So, you put in your name, email, and then choose a strong password. Now, head over to your email address and click the link we've sent to verify your account. Next, you'll need to provide some personal info, as is standard when using a digital investment service. It's strictly what's necessary. Crucially, we need to determine what products we're permitted to offer you. And if you're looking to set up an ISA, you'll need to be a UK tax resident. Now we get started with personal details, confirming our name, national insurance number, phone number, date of birth, country of birth, and nationality. Next, you'll need to fill in the source of the funds you'll deposit, as well as your employment status, industry, and annual income. You'll also need to input your address. Once that's done, you're ready to start investing. Though be aware that the verification process for your personal details can sometimes take up to a few days. Now, we'll take you through setting up an ISA. To start, just hit that Create Portfolio button. Then, give it a name. I'll go for my Wealth8 portfolio. Gotta keep things aspirational. Next, you select your portfolio type. We're going to go with Stocks and Shares ISA. And I'll select a regular fund. I'm not quite feeling adventurous, so I'm going to go for a balanced BlackRock MyMap 5. Next, I'll take a look at some of those fund breakdowns. It's also essential to take a look at both the fund fact sheet and the key investor information so that we're informed on just what our investments are. Next, we'll confirm that we have read and understood the following. Next, I'll decide how much to put in. I'll go for £100. And put in my payment info. And confirm that I'm authorizing the payments. And we're done. That's it. In 3 to 5 working days, the payment will be reflected in my Wealth8 account. Thanks for watching.
Okay, great. Thank you. We hope that was really quite informative and has answered any questions you might have. But just in case, we do have a Q&A session at the end where you can ask any questions in case you've already downloaded the app and have done this yourself, and you have some questions that might have occurred along the way, along the steps that you've taken, or if you have any questions about the investments or funds that we have, if the next session doesn't answer your questions, we will still have time at the end for some additional questions. So moving on, just to recap, Wealth8 is authorized and regulated directly by the Financial Conduct Authority. We have a wide range of ETFs and mutual funds, and these are already pre-diversified investment products, meaning that you don't have to pick individual stocks or individual bonds. The ETFs and funds that we have available on our app are already diversified investments. So that takes a little bit of the sort of decision-making, makes it easier for you when it comes to to the decision-making process. We also have different ones for different risk level appetites and ESG preferences. If you are someone who cares about, perhaps you care about climate change or perhaps specific social responsibility themes that you're interested in. So we have different products to suit those. Our funds are professionally managed by BlackRock and JP Morgan, and you can get started with as little as £8, whether that is a one-off payment or that is a regular direct debit payment that you would like to be doing on a monthly basis. So now we're going to quick sort of Q&A session back and forth with myself and Bien, where we will answer some of the questions and build some scenarios that might help you with your decision-making process or might help you with your thought process when looking to start investing in your ISA.
So hello everyone, I'm back again. This is being Pay Conchu for those who joined us a little late. I'm CEO of Wealth8 and I'm here with Cheta, who is Head of Products and Partnerships at Wealth8. So I thought it would be a good idea for us to sort of give you some sort of practical scenarios. We're talking about funds and ETFs and mutual funds and ISAs and a lot of jargon. And one of the important things that we do at Wealth8 is to demystify the whole language of investing, ensure that it is as easy as riding a bicycle. We want it to be counterintuitive. We want your journey on the app to be, pretty seamless. And we also want you to feel very confident and comfortable as you decide to start that journey to grow your wealth by investing in the products we have on the app. So I'm going to kick off with some questions, which will to Jetta. This is based on some of the feedback we've had from various people using the app or who have come across the app. And so the first one is, Jetta, tell us what the difference is between an ETF and a mutual fund, because we keep talking about having both on the app interchangeably.
Yes, of course. So an ETF, just like a mutual fund, is a basket of investments. So it means that in this basket, you have different stocks, you have different bonds, you have different stocks from different regions, you have different stocks from different countries, from different regulatory environments, from different industries, all put together in one nice bundle, and you have that, and that is called an ETF. Now, the difference between an ETF and a mutual fund is that an ETF is traded like a stock, meaning that the price changes, by the minute. Same way with the stock, you can buy at a price now, and the price is different in an hour's time. However, with a mutual fund, you have one price, and that price is given at the end of the trading day, meaning that it is technically not as liquid, so you can't trade it during the day. You can only trade it at the end of the day. But an ETF can be traded multiple times throughout the day. Generally, ETFs tend to have lower fees, and because you can trade them multiple times during the day, they are a little bit more flexible than a mutual fund.
Great. So, well, thank you. I hope that sort of helps to answer some questions. And by stocks, just to say, we mean shares, shares in companies.
Yes. Ownership
Now,
of a
what are the
company.
key things to think about when selecting? If I came onto the Wealth8 app and I wanted to select a fund or an ETF, and I know you have a slide that shows the different, this is a sample.
Yes. So before we get into what's on my slide, I'll just talk on the four key things to think about before you decide to select a fund. The first one is your goal. Is your goal to, get an income? Is your goal capital preservation? Is your goal long-term growth, short-term growth? You need to be aligned with whatever your goal is. The second thing is your time horizon. How long do you plan on being invested for? Now, the longer your time horizon, the more you're able to take advantage of the short-term market fluctuations and the volatility that could potentially occur. Because of course, with investments, things go up and they go down as well. Now, if your time horizon is long, i.e. it's more than 5 years, then you have more opportunities.
No, you're static a bit, but I think I was going to just jump in there and just ask you when you say time horizons, in terms of what is that? If I was a stacker, for example, and I wanted to save it
Mm.
for a car. You know, I want to buy a car in a year's time, you know, 1 to 2 years time. And if I'm also, or if I'm a minister of enjoyment, let's circle back to those money personalities. So if I was minister of enjoyment and I
Yeah.
save for my children's private school fees, say in 5 to 6 years time, you know, how would you sort of guide me in terms of what my sort of investments of behavior or investments of style should be
Yeah.
using what?
Great question. So first of all, just the disclaimer, this is not investment advice, and please seek professional advice from an investment advisor. However, because we are an educational platform, we can sort of provide you with certain guidelines. So now, as a minister of enjoyment, of course, we know that you're about that jai life. You like to have fun, you like to enjoy. The first thing we would sort of suggest is ensure that you have saved for your future enjoyment. And what do I mean by that? It means when you get any sort of income, be it your salary or dividend income or any income from whatever work that you do, ensure that you've taken a portion of that, you have saved and you have invested it for the future. Of course, like you said, your time horizon could be, you know, if you're saving for your children's school, you're looking at perhaps 5 to 6 years, meaning that you're putting that money away regularly for the next 5 to 6 years with the purpose of then, you know, reaping the returns from that to pay for your child's school fees. So as you get your income every month or however frequently you get an income, ensure that you've taken a portion of that, you've saved it, you've invested it, and you've put that money away. That way, whatever income you have left after you've sort of, you know, put it away for your future, for your kids, you can have guilt-free spending. You can enjoy, you know, whatever money you have left and enjoy it to your heart's content without feeling like, oh, I still have to do this, I still have to do that, I still have to save. You've done what you need to do, so enjoy your money, essentially. So that's probably what I would suggest. And of course, thinking about things like, you know, like I said, your time horizon, you've said that you're going to put it away for 5 to 6 years. It means that you can potentially take advantage of slightly riskier investments because you have a longer time to, you're not concerned about any short-term fluctuations in the market. So you're not looking at, oh, in the next year, what if it goes down? That doesn't matter to you because you've said that you're investing for 5 to 6 years, right? So you're looking at it from a long-term perspective. You're looking at it from what is it going to be like in 5 years. So whatever the market is doing tomorrow, in next month's time, you know, hopefully you're unfazed because you know that your time horizon is in the next 5 to 6 years.
So you're riding out the cycle. I guess if you're 5 to 6 years,
Exactly.
if at the moment you can afford to wait it out, and often things tend to, what goes up does come down, and sometimes what
Exactly.
goes down does go up. And I guess if you're a stacker, what you're saying is that a stacker is someone who, like I said earlier, who's very keen on saving, who's probably quite anxious about saving. But I guess what would you say to that stacker who is really putting money away in the bank in his normal bank account? What would you say?
Yeah. I mean, so to a stacker, right, perhaps you're used to saving in your regular bank account. And we all know that, you know, your regular bank accounts can never compete with inflation. And if you ever want to beat inflation and if you ever want to save for your future, then you need to look for investments that are trending above inflation. And the best way to do that, or one of the ways you can do that, is by investing, you know, in ETFs or in mutual funds, because historically they have been shown to track above the inflation rate. So if you're used to stacking your bank account, perhaps you can consider stacking in an ISA instead. I mean, you can start small if you're still feeling a little bit anxious. Perhaps you have, you know, £1,000 in your savings accounts. Maybe start off moving £200. And then once you're getting a bit more comfortable with the idea of investing, you can then move £300 and so on and so forth till you feel a lot more comfortable with the concept of, you know, of investing as opposed to just keeping the money in your bank account. Again, be aware, of course, that your investments can go up as well as down. However, if your goal is to, you know, save for your future, save for a particular goal, like a car, for example, you need to be earning some returns above inflation. And one of the best ways you can do that is by investing in mutual funds or in ETFs.
Great. Thanks. And now you've got this document open. Can you tell us
Yes.
what they are and why you've got them open?
So one of the key things when you decide to make an investment, you will be given a key information document and you'll be given a fund fact sheet. Now, it's important that you look at these documents, and in fact, you wouldn't be able to progress till you have said that you've looked at them. So it's important to look at them, and it might look like a lot of jargon. So you might be wondering, okay, so what exactly is important here? What should I focus on? And that's what we've highlighted on this slide. So you know the key things to look at. Now we have the first thing here, which is the objectives and investment policy. Now this tells you what exactly is the objective of the fund. So whoever, for example, here is BlackRock fund managers. When they sat down and created this fund, they had a goal for it. What is the goal? Sometimes you'll see in funds, they will tell you their goal is to have expected returns of, like, for example, this particular fund says 8 to 11%. So that is their goal, to have investment returns of 8 to 11%. Of course, you know that when you have certain goals that are, the returns are into the double digits, you need to understand that those tend to be slightly higher risk funds. So it's important here to see, to know what are the objectives and what is the investment policy. The second thing here is the risk and reward profile. So where you have here your lower risk arrow and your higher risk arrow. This particular fund is rated a 5, which is slightly above average, meaning that the risk being taken here is slightly above average. And it also means that the potential returns that you could get are slightly above average. Now, if this is something you're comfortable with, this could be, an interesting fund to invest in. The third key bit of information here is the performance charts. Now you can see here every single year except for 2022, they were giving positive returns. Now 2022, of course, was a special year. That was the year where the real sort of effects of COVID and post-COVID were quite apparent in the markets, and so you would see a lot of funds probably didn't do so well in 2022. So if I link this back to looking at your time horizon, if you had invested in 2020 and your time horizon was 4-5 years, you wouldn't be concerned by the dip in 2022 because that is not when you intend to, pull your money out. Now, if you had invested in, 2021 as well, same thing. If your investment time horizon was anything more than a year, you wouldn't be concerned by the temporary dip in 2022. If you invested in 2022, lucky you, because it means that you bought, stocks and you bought the ETFs and funds at quite a good price, and you are then reaping the rewards. As you can see in 2023 and 2024, the returns have gone up to, upwards of 8%. So these are the key things to look at when you look at a key investor document. So we have here, this is the BlackRock Mind 5, which is part of our core portfolios. And then we also have JP Morgan Transition, which is one of our social portfolios. So this is more ESG related. So if that is something that you care about and are interested in, we have some ESG related funds. This one, as you can see, because it is slightly higher risk, you're looking at returns, historical returns that are in the 23%, to 17%. Again, like you see in 2022, the markets didn't do well. That was something that was the case for most funds and most ETFs. But as you can see, the markets rebounded and are back in the positives in 2023 and 2024. I hope that wasn't too much jargon, but yes.
Hopefully people will ask more questions. But thank you for
Ask
breaking
questions,
that down.
yes.
Exactly. What is a good time to invest? Is now a good time, for example? And what would you say?
So my answer to that is something I've heard, so many times. And the saying goes, time in the market is better than timing the market, meaning that there's no point in waiting to say, oh, let me invest tomorrow because the markets might be doing better tomorrow. You're never going to get that timing right in the long run. So it's better for you to spend a lot more time in the market, i.e. you start now and be invested for the long term, rather than saying, I'll wait till tomorrow. You don't know what tomorrow is going to hold. Tomorrow may be better, tomorrow may be worse. It's not worth, in the long run, taking that risk and waiting. It's better to start now. I'm sure you must have heard the best time to invest was years ago. The next
exactly.
There is no point in waiting. Start with whatever you have, start with wherever you are, even if it is, like I said, we start from as low as £8. Even if it's £8 you have, you're better off starting there than not starting at all.
Great, thank you. So time in the market is better than time in the market. I think that's worth remembering for everyone. And you know, what would you say? How come, my one question I have in my mind, I think many people will ask is, can I withdraw money from my ETF or fund at any time? Even with the ISA, especially when I put money into an ISA, are there any restrictions on withdrawing funds?
So you can withdraw anytime you like from your ISA. However, of course, when thinking about investing, it's important to know that investing works best when you leave your money to grow for a long period of time.